The market told you exactly what was going to happen. It told you months before, maybe years before. It whispered it in the data. It screamed it in the patterns. It left the evidence in plain sight for anyone willing to see. Most people were not willing to see. Not because they lacked intelligence, not because the signals were hidden, but because seeing the truth required them to act against everything they felt in that moment, against the crowd, against the comfort of consensus, against their own hope. I have spent decades learning to hear what markets say when no one is listening. And what I have discovered will change the way you look at every chart, every headline, and every position you have ever held. Stay with me, because what I am about to share in the next few minutes is the difference between the investors who survive market cycles and the ones who are always one step behind them. It was the summer of 1992. The British pound had been locked into the European exchange rate mechanism for 2 years. The mechanism was designed to bring stability, to bind European currencies together within a narrow band of fluctuation. On the surface, it looked like order, it looked like strength, but beneath the surface, the numbers told a different story. Britain's economy was weak. Unemployment was rising. Interest rates were being held artificially high, not because the British economy needed them there, but because the ERM required it. The British government was not managing its economy, it was managing an illusion. I could see it. Not because I had access to secret information, not because I had informants inside the Treasury, but because I was willing to read what the market was already saying and follow that reading to its logical conclusion, no matter how uncomfortable that conclusion was. The pound was overvalued. Everyone in the room knew it. The economists knew it. The currency traders knew it. Even some members of the British government privately knew it. But no one was willing to say it out loud. No one was willing to act on it, because acting on it meant going against the institution. It meant betting against a government. It meant standing alone in a position that, if you were wrong, would cost you everything. On September 16, 1992, a day that would later be called Black Wednesday, the British government spent billions defending a currency that could not be defended, and my fund made over $1 billion in a single day. Not because I was reckless, not because I was lucky, because I had been listening to what the market was already telling me for months while everyone else was looking the other way. That lesson is not about currencies. It is not about 1992. It is about a principle so fundamental that it applies to every market, every era, and every investor who has ever placed a trade. The market is always speaking. The question is whether you are truly listening. Principle 1. Markets speak in divergence, not headlines. Most investors listen to the wrong signal. They watch the news, they read the earnings reports, they follow the analyst upgrades and downgrades. They track what is being said about the market rather than what the market itself is doing. This is the first and most costly mistake an investor can make. The market does not communicate through language, it communicates through behavior. And the most powerful signal it ever sends is divergence. The moment when the market is doing no longer matches what the world believes it should be doing. In 1992, the divergence was clear. The British pound was being held at an artificial level. The economic fundamentals pointed sharply downward. The gap between the reality and the official position was widening every week. That gap, that divergence, was the signal. I have seen this pattern repeat itself across every decade I have traded. A currency that refuses to fall when it should. A stock price that refuses to rise despite strong earnings. A market that shrugs at news that should have moved it dramatically. When the market stops responding the way logic says it should, that silence is not nothing. That silence is everything. The market's failure to react is the most powerful reaction of all. Apply this now. Look at the positions you hold today. Look at the broader market. Ask yourself, where is the divergence? Where is the market behaving in a way that does not match the narrative? That gap, wherever you find it, is where the real information lives. Remember that.